Hello everyone and welcome to Pivot Boss Masters. This is confirming entries with the footprint, and this is part of our execution portion of the core training, and this is one of the most powerful approaches that you can do to confirm any trade location that you have, is confirming with order flow, and specifically confirming with the footprint, which visualizes the order flow that's being transacted at the moment. And when you're able to pinpoint precision entries and forecast where those rejections or reactions may occur, you'll then be able to use order flow to further confirm these entries and give you very, very good odds of a high probability trade. And so that's what we're going to look at in this training. So let's go ahead and get started. We have one slide for this presentation, and then we have 9 charts that we're going to look at. Confirming with the footprint. Elite traders confirm trade location with order flow analysis. And for those of you who have not gone through the prerequisite for this training, order flow analysis is a fantastic way to analyze the current order flow that's coming into the market right now. And that's very, very powerful information. So order flow is all about the flow of orders that are being transacted right now at the market. And order flow analysis is simply reading the flow of transactions and future orders to reveal the story of the market. What's happening? Are buyers winning? Are sellers winning? Who's winning the battle? And so that's what we're going to be looking for when we're confirming these entries with the footprint. We're going to be looking and visualizing that order flow onto the footprint charts. And so footprint charts offer a powerful way to visualize order flow and allows traders to identify where market participants are doing business. Where are they doing business? Where? Right here. This is where they're transacting right now. And if these bulls or these bears, someone gets trapped, they are going to be the fuel that sparks the next big move, especially when these absorptions occur at edges of ranges, especially when they occur when prices are tightly coiled. Any of these various scenarios, that's what you're looking for. So let's talk a little bit about the footprint. Footprint charts show market orders that are being transacted at present. These are market orders. These are traders that are executing market orders. So these are labeled or described as aggressive participants. And aggressive participants are those who need to transact that order now. That's why they submit a market order, right? I want to get in now or I want to get out now. And they're transacting that market order. So they're aggressive participants. They can't wait. And a footprint chart also shows the volume delta between buyers and sellers. So this is the difference between the amount of volume that's transacted at the bid versus the offer. And that reveals buy and sell imbalances. And a buy imbalance occurs when there are more buyers that buy at the market versus those who sold at the market at that price. And these buy imbalances may become the fuel that sparks the next move. Same thing, sell imbalances occur when more sellers sell at the market versus those who buy at the market. And that leaves behind a sell imbalance. And this may become the fuel that sparks the next move, especially depending upon where it may be in the chart. What's great about a footprint chart is it reveals where the aggressive participants are doing business. Where are they executing these orders? But there's someone on the other side of those trades as well, and these are called passive participants. These passive participants use limit orders, and this is how they're able to absorb that supply or demand. Passive participants look to absorb excess supply or demand in order to trap these aggressive parties and then run their stops. So they're trying to trap these aggressive participants and use that absorption to basically run them out of their stops and fuel the next move, higher or lower, depending upon their bias. So that's basically the footprint chart, and we'll jump into these in a moment. Now, when it comes to confirming with the footprint, it's very, very simple for the most part. There's several strategies here that we'll look at, confirmation strategies, but they're very, very simple. The first one is buying dips. Obviously, in the market that's trending higher, the goal is to look to defend counter trend rotations, buy dips in the direction of the existing move. Yesterday was a huge trend day. That was an opportunity to buy dips. So the ideal approach to buying dips in a bullish trending market is to identify trapped sellers on the dips. If these sellers don't get paid, their buy stops will fuel a move higher. So just think, for example, if you're trending up like this, boom, 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 on this pullback, if you get a lot of sellers that get in right here and price doesn't go down, then their buy stops start to get triggered. Buy stops, buy stops, buy stops, buy stops, and that's what fuels the next move up. And on the flip side, selling rips. The ideal approach to selling rips in a bearish trending market is to identify trapped buyers on the rips. So trapped buyers on the rips. So basically, if you are downtrending, 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 this is a rip. If that rip has lots of buying balances on it and those buyers don't get paid, their sell stops start to get triggered, and that's when you start to see the thing rotate lower. So again, these imbalances can show us where the market participants are doing business, and then it's up to us to judge whether they are getting paid or not. If they're not getting paid, it's time to hunt the stops. If they are getting paid, then maybe it's time to join the party. So that's buying dips and selling rips. Very, very simple. And again, that's all you need to know with confirming those types of moves. In terms of fading support and fading resistance, it's the same approach, it's just different location. When you're fading support, the ideal approach is to fade support where there's major rejection, right? The goal is to identify trapped sellers at this rejection. So typically speaking, rejection will occur at resistance or support, right? Rejection will occur at a previous high or a previous low. That's resistance or support. So those are the areas you're watching. So the ideal approach to fading support is to identify trapped sellers at or near support. And if these sellers don't get paid, these late sellers don't get paid, these sell imbalances will fuel higher prices as their buy stops come out. They'll be forced to cover their trades. Fading resistance, the ideal approach to fading resistance is to identify trapped buyers at or near resistance. And if these buyers don't get paid, these buy imbalances will fuel lower prices as sell stops come out. So we're going to see several examples of these, powerful examples, examples that if all you do is study these examples, that's all you'll need to know to find high probability trades with great entry location and high odds of working out. So let's go ahead and get started with looking at the charts. All right, here's our first example. And this is the ES. And this was the previous session when we had a very bullish trend structure developing. This was something that we looked for early in the day. We were looking initially to reject any prices above 76.5 or looking for rejection above 76.5, which is right here. And when price got above it, it was holding. We were in the trading room, and that's when I mentioned this is an opportunity to look for any failed range expansion. Doesn't mean to sell it here. It means if these right here, if those buyers don't get paid, then they drop back below 76s. Then you start to see resistance or absorption, and then you can be negotiating the move downward. But that didn't happen. Instead, as soon as price pushed above it here, it held for a few, 20, 30 minutes. And then just ahead of RTH, boom, it had a burst move up. And as soon as that happened, right there, as soon as this thing started to push up and go, right away heading into the open, that's when I mentioned this is likely going to be a price discovery phase now. This is likely going to be price discovery, and the idea is to buy the first pullback after the open into the LVN below, right? Or into the PIMAs or into R3. So I mentioned several approaches, and that's exactly what happened. But it was a shallow dip. Here's the open, is that orange dotted line right there. And right at the open, it pulled back right into the PIMAs. And that was just shy of the LVN by a little. But again, that was a spot that was defended hard. And then you saw the rotation up through the next LVN. This rotation was defended and continued. That's every single time you're in a trending market, the goal is to defend these rotations. And your idea is to defend those pullbacks at a number of levels. Ideally, the easiest way usually is just bringing up these pivot-based EMAs, the PIMAs. And if they are stacked and sloped, you look to defend pullbacks into the trigger zone. Price hit the trigger zone right on the button and never even went inside and continued higher, and there was more rotations ahead. But that's all you're looking to do. So now if we can look for, in the footprint, trapped sellers here, or sell imbalances here, then we know that there is fuel there, that if they become trapped, their buy stops will lead to a significant squeeze ahead. So that's exactly what we look for. So now if we have an idea, like yesterday, right on this bar, as this thing started to push up, that's when I changed our tune from looking to fade to looking for a price discovery phase. Now I was asked also, how did you know that was going to be a price discovery phase? And of course there was many things that I mentioned, but number one, R3 was very bullish, VWAP was sloping, and then there was no rejection here. And when that thing pushed up, I knew that 76.5, that's an edge, right? That's why I say watch the edges. 76.5, it's called a decision point. That was a decision point. Either we're going to reject off 76 and drop, or we're going to push through it and see expansion in a price discovery phase. That's why it was a decision point in the charts, and that's why I flipped my tune right away and I said, okay, let's go long and let's buy dips. So once you have the strategy to defending pullbacks at the PIMAs, the LVNs, perhaps R3, then you go into the footprint chart and see, can we find trapped participants? So let's go down into the footprint chart. This is what it looked like. So when we dropped into the footprint chart, this is on the second rotation. So the first rotation happened after the open, and then we saw this big squeeze up. So this is the second rotation. So price pushes outside of R3, and this is R3 right here. You see that red box right there? That is R3. That's the third standard deviation above VWAP. That's what I call the R3 pivot boss band. And anytime price trades outside of R3, rotations into it are defended by participants looking to extend the range. And so we were looking for pullbacks into that zone. We identified a pullback opportunity into about 82, 83s, and price came back right toward that zone there. And then we started to see all of these sell imbalances come in. And that's very important, because whenever you have sell imbalances, so on this rotation, sellers, 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 if you add those totals up, it's quite a bunch, right? I mean, you got easily 10, 12, 14, 16,000 sell contracts that came in at that area. And remember, if these sellers, that's a lot of volume, if these sellers don't get paid, which means if you're selling, just think of it this way, you sold 2,000 contracts. You just sold 2,000 contracts at 82.5, right? And then price goes down 1 tick and 2 ticks, and immediately, see that green stripe right there? Boom, goes bid and pops back above that zone. An additional 5,000 contracts. Now this is a sell imbalance too. Those were 5,600 more contracts came in to sell at the market at that price than did buyers, right? So more contracts came in to sell. 5,600 more contracts sold there than bought. But did price go down? No. Price went up, right? Imagine that. Imagine selling 8,000 contracts of the ES and it does not go down. You know why? It's because passive participants are absorbing there using limit orders. And if all of these sellers are trying to get this thing to break through the floor, but they're not, and instead price is ticking higher, it was right here where I mentioned, I think this thing's about to go now. The trap is in. All of these sellers were here, and then boom, this is the beginning of the buy stop starting to come out, and then you see the squeeze ensue. So this was very, very powerful, but again, you have to understand the concept here of who's doing what? These sellers right here are selling at the market. They are selling, right? They are hitting the bid. But price isn't going down because you have limit orders that are sitting here and they are absorbing all of the supply. And these are passive buyers. And those passive buyers, typically speaking, have deeper pockets and are looking to absorb and use those sellers as fuel to push price higher. That's typically what happens. And so yesterday when we were looking at this live, that was the idea in the trading room. That's what we looked for, and that's what played out. Oh, one last thing. If you look down here at the bottom, this is the volume breakdown indicator. VB, the volume breakdown. So basically it's doing the same thing here. It's looking at the volume delta, but it's doing it bar by bar, bar by bar, bar by bar. So that's another way that you can look at this. If the market's trending up on this pullback, if you look down here and you see a lot of red on that pullback and price isn't going down anymore, that's probably absorption of those sell imbalances, and if they become trapped, their buy stops will come out. So if we go to the next chart, so here's how it played out. All of these late sellers don't get paid. It started to go right here about 82.75, then 83s. Then right here, another 5 contract sell imbalance comes out, and then price goes up. Then another 1900 sell imbalance comes out, and price goes up. That's how you know that this market is strong, because sellers are clearly coming into the footprint and they are getting absorbed and rotated higher. Eventually, look at all of the green that comes out. Boom! Because those are all the buy stops that got triggered, and those buy stops are the fuel that push price higher, right? And so our idea was that we would likely see a move into 87, 88s, and price got into 87s on this move, and then later on messed around and did some more. So, today we were trading near 90. So a nice continuation, a great pullback, high confirmation on this zone, because we have a very, very bullish trend that was emerging. We were outside of our 3, which is indicative of a price discovery phase. We saw lots of sellers that came in and they could not influence price lower, so they became trapped. And then subsequently you saw this thing rotate higher. That was a fantastic opportunity. And again, anytime something gets into a unidirectional trending market, this is the approach to use. Look to identify the pullbacks at the proper zones, like the trigger zone in the PIMAs, like in R3, like at LVNs, right? Those types of things. Use market structure. And when you see this fill up the red there and they can't get it going down, and instead it starts to tick up, all of those sellers start to jump ship and their buy stops trigger the move up. This was a fantastic trade right here. This was awesome. This happened Monday. This was Monday. And this is crude oil. And this is after the significant sell-off we had just seen recently, where price really, really dropped. And what I mentioned, pre-market report, and what I mentioned before was if price bounces into the pivot range the next week, the weekly pivot range, which was 50-20, it's not on the chart right now. If it rallies into that level, given the downtrending structure, we had a pivot range here for the week, then we had a weekly pivot range here, and we had a weekly pivot range that was like this. So I said if it goes into 50-20 here, that's where you want to look for rejection and look to sell it. And if you sell it, right, if it rejects here and you get into that thing, the targets are the previous week's close and the previous week's low. Those were the targets. And you can see how it played out. Now this is what it looked like with regards to order flow. When price rallied into that high here, it was just beyond this high, and right here is this. Major buying balances. Now keep in mind, this is the high right here. right? That's the previous high. Right there, above that high, is all of these buy imbalances. And this is crude, so it's not going to be thousands all the time like the ES. So it's 330 plus 230. So you have 560 plus another 40 up here. So 600 contracts that have bought more than sold up there. What does price do? After those buyers buy, did price go up or did price go down? And that stripe shows it went down and it went down. Again, just put yourself in their shoes here. You just put in, and again, this isn't one buyer or one seller or one participant, but I like to make believe. So just pretend here that you sold 330 contracts right there, 2 ticks off the high, and you bought 331 contracts right there, 2 ticks off the high, and it didn't go up. That is scary, right? To buy 330 contracts here and price not go up and instead sell off hard, again, that's indicative that there are major passive sellers up here using limit orders, and they're going to absorb everything into that zone. And again, that was the 50-20, which was right where the bottom of the weekly pivot range was. It rejected, bang. Okay, so that's the initial rejection. So there's always the initial rejection. It's a market reaction. If a market price is hit, that's a key level, and there's a significant reaction, then you want to get involved. So that's just the initial reaction. I'm not even saying go short there. What I'm saying is look for the next major shakeout leg or next bounce, and then look to get in on that pullback if there are buy imbalances again. And that's what happens. Price gets up, and then there's buy imbalances again. I mean, another 900 contracts bought on this high, 3 ticks off the high there. And then bang, it drops. Then price drops below value. This is VWAP. This blue dotted line is VWAP. When price drops below VWAP, right here, this is what it looks like. That white box is VWAP. Look at all those buy imbalances and all those buy imbalances. That's here and here. So that's that one, and that's that one. So you have hundreds of buyers, buy imbalances, hundreds of contracts that are buying value. They are buying value, and value is not going bid, which tells you again that these passive sellers who are using limits, they rejected here, and they're going to continue to defend all rotations. So now larger passive sellers are defending value and absorbing these buy imbalances, and that's the point where this thing melts, because that's the last line of defense. If hundreds of contracts of buyers can't keep value bid, then those buyers are in trouble and their sell stops will feel that move down. This is a fantastic example, and again, this was something that was not hindsight. This was forecasted. This was in advance. This is exactly what we were looking for ahead of time, and then it plays out. Now again, won't always be that perfect. It's up to us to read the market's reaction. And oftentimes what I tell you is you don't even have to do anything. Don't just let it do it. Let it happen. Just wait and let the rejection happen. Let it happen. Once this major rejection occurs, there's going to be a re-entry. It's very rare when you don't get that re-entry, but there's going to be something. And there's going to be an opportunity to get in, but you can see what happened here, and it played out perfectly. Now, again, precision entries. This was a major rejection right off 50-20. That was the zone that we talked about to sell. So it only went 2 ticks above the level that I called out before. Then right here, pullback. Then right here, a pullback. But from that 50-20, this thing dropped back to 49s. Again, another $1,200 per contract drop just to that zone. Very, very powerful. This is what it looks like if you jump into the footprint chart to study the rest of the chart and see what it looked like. Remember, this is the push up here, and that's that previous high. Here's that previous high I talked about. Look at price get above that high, and all of these And it's not just that. I mean, if you look at this high right here, it's these buyers as well and these buyers. All of those buyers bought above that high, and then price didn't go up. So the stops came out back below and dropped this thing. The other thing that you can look for to confirm that this thing is weak is look at this right here. More buying balances come in, huge, 1,500 contract buying balance, and the thing drops some more. That's very, very bearish. Now on this rotation up, right? Look at this. Look at all those buying balances. But those aren't trapped. They have to be trapped participants. And my definition of trapped is if you have a buying balance like this, is the market above that level or below it? That's my definition of trapped. Very simple. And so buying balance here ticks up. Buying balance here ticks up. Buying balance here ticks up. These aren't trapped. These are actually getting paid. These buying balances were getting paid. It's not until here where they encounter the significant rejection caused by the passive sellers and their limit orders. That's where they were hunting. And so once price ran into that buzzsaw of limit orders, that's where the absorption occurred. Those late participants got trapped, and then the sell stops came out. This right here, this is where the capitulation begins. It's when price holds at VWAP and you get hundreds of contracts of buyers and it does not go up and instead ticks down, That's the time where the market says, you know what, right now price can't even sustain value. This must be headed lower, right? And then where does it go lower? Well, then you're looking to the previous close. You're looking to the previous low. Maybe you're looking to value low. So perhaps we're going to go down there and find 5-day value low, or we're going to, whatever your target may be. But if the market and lots of buyers can't get value to stay bid, it's going down. So the reason I mention this is because you have to start having conviction with these strategies and tactics and concepts. You have to believe in them. I believe in these concepts. I know that when I see this happening, that's not good. This should happen. And that gives you conviction to get in there and mix it up. Get in there and put your limit there and offer with the offers. And then from there, you could be looking at much more weakness ahead. This is a good question here. How do you determine if the previous close for the day, week, or month is the one to aim for? On any given week, it's the weekly levels that are going to be the ones that are in play. The weekly levels are usually, if you had to err toward one of them, go toward the weekly levels, because those are the levels that you can play throughout the week. The daily levels are good as well, obviously, and sometimes they coincide with the weekly levels, like a Friday high-low close, right? The close will also be the same as the weekly close. Sometimes the low might be the same. Sometimes they coincide. But like, for example, in that crude oil one that we're looking at here, this was a weekly idea based off the weekly charts because the analysis was coming from Friday and Monday morning. So looking at that one was weekly. But then the earlier rejection was based off a previous high of the previous session. So it just always depends, but for the most part, if you wanted to stick to one right away, I would use the weekly Pivot Boss pivots. So the weekly prior high-low close in addition to the pivot range and the extensions. Now the monthly ones, I love to pay attention to those at the beginning of the month. So Monday is May 1st. That'll be brand new pivots for the month. And then we'll look to scan, we'll look to identify any potential pivot range ideas there using those pivots. And for example, higher value relationships, lower value relationships, change of bias relationships, those types of things. And that can all be seen, if you haven't gone part of that training yet, our proprietary training for Pivot Boss bands and Pivot Boss pivots details those as well. So that's usually what I do is I focus big time on the previous week's key levels. I'll also focus on the daily chart, or the daily levels, as they happen throughout a day. And in the previous month's levels and those monthly pivots, I like to pay attention to those at the beginning of a month, because you can get that early idea early in the month and then just let it go toward those targets the rest of the month. So that's a great question. Thank you for that. So this is what it looks like when the thing continues to roll lower in that same example, right? This is the significant rejection up here. Above that high, remember, boom, drops. Comes back, here's this retest entry right there. That's what I call the retest entry. That's about where you want to get in. And then when price drops, here's VWAP, right? That's where the capitulation begins. And then boom, look at that. Major sell-off occurs. It was a nice little rejection, but after price pushed through these lows, that's where the sell stops really come out. Because at this point, it had, capitulation hadn't happened just yet, but this was the beginning of what starts those stops to get run, and that happens about beneath these lows right there. And then look here. Look at all those buyers get in, and boom. Look at all these buyers get in, and boom. Look at all these buyers get in, and boom. Look at all these buyers, boom. When you see that happening, it is very clear that passive sellers using limit orders are just consistently rolling down and absorbing all buyers and using their orders as fuel to rotate this thing downward. So again, keep this in mind. Say you're a buyer and you bought right there. This was a pullback in the VWAP, you bought right there. After you buy, you're a seller. You're either going to sell up here and make some money, or you're going to sell down here and lose money, right? So after you're a buyer, these buying balances, they can't do anything else to help price go in their favor. They are at the mercy of the market now. Unless they add back or something like that. But even then, that's a dumb trade if you're underwater. So if you see these buyers come in, the reason I say you have to absorb those buyers is because they need help to get prices going up. The help that gets those prices going up are trapped sellers. Trapped sellers help their prices go higher, right? When a seller sells, say a seller came in and sold 50.10 and all of a sudden didn't go down, that would help these buyers because those sellers and their stops would come out and it would help the buyers. But when this buyer comes in right here, the next trade is to sell it, to flatten the trade. You're either going to sell it for a loss or sell it for a gain. So as soon as they get trapped right here and price goes down, they're trapped. Where are the stops? Because they're coming out, right? And so that's what we're looking for. But a very nice continuation and a great trade that played out here in crude. Here's another look at crude, and this was over the last couple of days. Again, two of my favorite patterns here. This is the absorption signature. Two of them, back-to-back days, major squeezes from each. And we had traders in the room that grabbed them. I mean, that's phenomenal. The previous day, this was a nice rejection down here. We were looking for defense of 49s for a shot at rotating it back to 49.50 to 55s. By the time that we got out of the room that day, it was still absorbing, so we didn't see the squeeze until later, but the squeeze turned out phenomenal, right? This is all you're looking for. Is right here is S3. 49s are right here. It's also an FOMC level, so there's a lot of key level support down there, and price drops down and pops back up very strongly. That's a rejection right there. So right here, that's a low and price drops below it. It immediately rallies back above that low, and not only that, but rallies through the previous high. That's a very strong reaction to that support. And when that occurs, you begin to see the absorption signature develop. And so if you look to see what that looks like right there, that's over 1,400, 1,500 contracts that's sold at that price, and that's about here. You also have all these contracts and all this. So all of those are all the sellers that came into here, and eventually stops came out about right there. boom. That's the type of move you can get. So here's a question. For execution, would a stop be the last high or low or just a number of ticks? That's a great, great question as well. Usually for me, it's a number of ticks, but I like to coincide it with something that's beyond structure, price structure. So what I mean by that is I don't like to say if I'm going to short here, it needs to be above the high. I don't like that. But what I do like to do is if it coincides with my, hey, if I'm going to play, say, a -10 and a +10, so -10 is my stop and a +10 is my T1, then ideally, if I'm getting short here, then I want my +10 to, yeah, be beyond that high. That would be nice. But I don't want to get in short here and then say, I'm going to put it up here and it's going to be a -25 ticks. That's not what I would do. Instead, I guess primary number 1 would be a number of ticks, and then 1B would be, hopefully it's beyond my market structure, right? Because ideally, if there's a rejection, if this is a rejection, it will be the low. It will be the low. But remember, I don't like to put my stop down there and hold it all the entire time. Because if we trigger in the absorption zone, then we want to get a T1 quickly. And now I'll keep that stop, but it's a break-even stop because I've already triggered half on a T1. And as I mentioned yesterday, this has a shot to go here unless the stops start coming out below 48.90. And they never did. It stayed in it. So, yeah, hopefully that helps a little bit on that question. Now over here, this was today. This was today, and this was phenomenal because we saw it live in the room. We had the analysis there for the traders right away. And not only that, but one of the traders in the room was the one that announced the rejection first. Brent says, hey, that's a nice rejection down there on those lows off of the 48.94s. And I had just seen it happen as well. But when I look over, the thing that struck out was the kurtosis that comes off. And it's a little hidden right now. But the kurtosis is when you have the data point that just sticks out off the profile and everything around it is kind of smaller. So when that kurtosis formed, it was because there was significant sell imbalances on that low. And so what I mentioned at the time was that that right there is a great rejection, and now any rotation into the LVN is going to be defended by bulls for a shot at running the upside stops above 49.20 because these were bears defending the previous week's low, and a shot at rallying this thing not only to 49.60 but through it. Because this morning I mentioned 49.60 was an important level, and if price pushes beyond it, we could see a significant rally attempt. And it did do that and pushed really, really nicely higher. I mean, it continued into about at least 50.20 before it started to come back some. But that was our initial idea this morning was, hey, watch those stops above 49.63 because they could trigger. And if you're going to be watching those stops, then ideally you want to be trading at the opposite end of the range so that you can get into that move ahead of time. And so this was a fantastic rejection signature here. This was an absorption signature. Major, major rejection here. That's the difference. Today, when we were looking at the ES, we were looking for signs of rejection above the previous high. And it was a dogfight up there. It was very, very difficult to discern who was winning, what was going on. At first, there were lots of buy imbalances, and then lots of sell imbalances started to come after. And then price drops a little below, but still with sell imbalances. And then some buy imbalances, and it was just a mess. And for how long? I mean, it was, what, a 30 or 40-minute fight up there. That's not rejection. Rejection occurs fast. It's swift. It's a market reaction. This was a swift, fast market reaction. When price dropped down here, it did not stay long. Large sellers came in and it immediately popped back up. That's a rejection. And that's why Brent called it out right away. And that's why we knew exactly what to do with it right away. This was the zone to defend. We knew it coming into the EIA report, and I said, watch for the stops to come out above this zone, and we start to head higher. But I also mentioned, this pattern is not flawless. This pattern is not flawless. There are sell stops now below 49s. Because if you're buying here, and you're buying here, and you're buying here, your sell stop to build up as well. So if this had failed here, this is what we mentioned right before the AIA. If price starts to push up here and starts to fail, then the stops are likely going to come out here. It's going to do that, right? So we detailed both scenarios, but we were bullish bias as long as this zone held, and bang, what a move. So that was a significant opportunity that played out perfectly. It was phenomenal. If you don't see a formation like this happening at an edge, sometimes it's not a good idea to engage unless you see some sort of major rejection, some sort of rejection signature that you know how to play. So here's a good question. Once we see the trapping process on the footprint, should we enter where the tripping happened or after the stops come out? So the goal is to bid with the bidders and offer with the offerers. So my goal is never to get in when the stops come out. It's to get in ahead of that. The analogy I would use is, if you're going to take a mode of public transportation, say the metro rail or say a bus, are you going to try and get on the bus when it's already moving? Or are you going to get on the bus when it's at the stop? If you try to get on the bus when it's already moving, you're going to get flattened. You're going to experience horrible fills. It's horrible. It's bad. You're going to get run over. Yes, you can get in there and say, I bought here, and it goes, but it's not always the case. This was an awesome opportunity that really lifted. But you never know what can happen on that breakout. But down here, it's much more orderly, much better. You know where the entry is. So I would say this is where you're entering, the first pullback. If this is the rejection, you want the first pullback to that level, the first one. Not the second, not the third, not the fourth. Get the first one, if at all possible, and get to a T1 quickly. So this morning, when price came back to that zone, it bounced 19 ticks to this high. And so I mentioned there was enough to get a plus 10 there, no matter where you got in. Even if you were a little late, you can get a plus 10. That gets you to break even. If you get to that plus 10 and you get break even, the second rotation can be an add back. That's an add back location. So on the second rotation, you don't have to add back half. You can add back just a quarter or a fifth or a third or whatever. You don't have to add back everything that you took off up here, but you can add back something because you got paid. If you got paid on a T1, then you have flexibility to add back. And so that would be in here. Typically speaking, I like the first couple of rotations and not so much the rest, but sometimes it depends. Some of the signatures take 2 days to develop or 3 days, and it becomes a larger macro pattern that delivers a multi-day event. This one happened to be a formation that took about 2 hours, and then bang, it released all in about 20 minutes. Here's the breakout point. That's 9:30. This high right here is about 9:34. I mean, that's huge. That's a big time move. That's not as far. I mean, it went even higher than this, but initially, what a great squeeze. So let's look at this in the footprint again. This is what it looks like when you have an absorption signature. You have the push down, and look at all of those sellers that come in right here. 2,000 contracts sell imbalance on the last 3 or 4 ticks, and price pushes up. By the end of this 10-tick range bar, right, we had been down here, and then we were up to here already. You can see this little stripe right here, right? That little stripe tells you that price opened that range bar here, it dropped down to this low, and eventually closed up to this high, right? So that right there shows you 2,000 contracts get short, below 49s, and bang! big push up. That's the rejection that Brent called out. So when I looked at the footprint, these large buying balances made kurtosis there on the volume profile. It was a little bit farther out, and then we had a nice well-defined LVN, and then of course by the end of the day this changes a little bit because all the rotations that go into it. But this thing squeezes, and then boom, right back to the zone. Look at this right here, right? Because we talked about before, after this rotation here, this is what I mentioned, now bulls are going to want to defend the LVN below. So we know what to look for. Now what we want to do is look for trapped participants. So when price drops into that zone, look at all the sell imbalances that hit down there. Look at all of them. I mean, again, another 12, 13, 14, 1,500 contracts down there, and price goes up. And then price comes down again, and those last 4 ticks again, more buying balances, and it's almost picture perfect. You can tell it's almost algorithmic or program based because the order levels are almost perfect. 800 and 800, 400 and 400, 200 and 130, 60 and 40. I mean, it's very, very similar. And again, that's because that's how institutions and programs and algorithms, that's how they create an area to absorb and then create an iceberg order there, right? That's what we're looking for. And that's the entry point right there, ideally. Ideally, that's the zone. And so, nice little push up, and this thing went this way. Now, we knew that this thing was building up, and we were heading into the 930 report, and price was coming into VWAP. Now, this is the other part of this equation. Look at the top end of this range. You see all those buying balances up here? And that was leading to rotations downward, right? This is the other part of the issue, is that when you have, say an institution comes in here and says, we're going to buy, several thousand contracts here and create a low and push this thing back up. I always mention there's the primary algos or programs and the secondary algos or programs. So a primary algo might say, when it gets into this zone, buy 1,000 contracts, right? And when it gets up to here, sell 500 contracts, because you want to keep it a ceiling up there so you can come back and get filled again. Then when it comes up here, you buy another 1,000 and you sell another 500 up here to keep it resistance and keep it a ceiling so that you can get filled some more down here, right? You can build a position that way. And then when price comes into that zone, the next time it comes up, instead of saying sell here another 500, they take that off and now let the floodgates open. The other thing is that you do have true sellers here trying to defend these pullbacks. And these true sellers, after many, many rotations, start to have buy-in balances that pop in above. And that's why I mentioned this morning that despite the downtrend in VWAP, because typically in a downtrending market you want to sell VWAP, but that would not be the case in this instance because you had so many sellers here that you had buy-in balances that were coming into VWAP like this. So if it hits VWAP, it's going to go through it. And that's exactly what happened. So here's the look. Here's the major significant rejection. Boom. First rotation down, absorbed, bang. Next rotation down, absorbed, bang. Next one here, next one here. Right there is where the stops start to really come out. You see those buy-in balances? This is the one that killed it. That's where the capitulation occurs. Just like in that previous example where you had buyers trying to defend value, and when buyers can't get value to go bid, then capitulation occurs. This is the opposite of that. In a downtrending market, bears are trying to keep value offered. And so they are right there, literally right there, selling VWAP, and price pushes up. That's the last trap participants that really unleash this thing, and then bang, the flow happens. So every time we're looking for something like a significant rejection in the charts, it's about being patient and just letting the market do its thing. I'm not trying to buy this rejection here. I'm not trying to be the smart person and say this is going to be the low. I'm going to put an ambush limit here. Sometimes I've gotten those filled and it's been perfect to the tick lows, and sometimes it smashes right through that level, and I would have never taken the trade if I would have just waited patiently to watch for signs of rejection. So I don't say just put a blind ambush at some support or resistance. There are times where you can put the ambush, right? Like when this thing's coming back, the retest entry, it's basically an ambush where you're just leaving it there to get hit, typically speaking, after the initial rejection, but not blindly here. Let the market react. Boom, it reacts. Now, let's defend the LVN and trap these late participants. Boom, boom, boom. The stops come out above VWAP as we expected, and where does price go? It goes right to R3. Right to R3. After taking VWAP bid, it goes to the third standard deviation of VWAP, and that was a quick squeeze to 49.70. But then in the market, in the trading room, I mentioned that we could see an additional continuation toward 50.30, and it got to 50.20 before it really started to kind of falter. But a nice continuation. This is what the absorption signature looks like in the footprint chart. And then again, when these trap participants here can't keep it offered, the stops come out. When this thing starts to float higher like it does, additional sellers that become trapped become additional fuel as well. So if you're long in this thing, you want to see sellers come into the market and get trapped. You want to see sellers come in right here, in the footprint at least, and get trapped. That's what you want, and that's what can keep you into these trades. So that's the last example there. Those are three types of examples here that we looked at. Absorption signatures, we had major rejection as well from a previous failed high, failed range expansion with an absorption signature, and we also had just a general buy the dips type of opportunity. Selling the rips would be the same, just flipping the participants. But again, identifying where these trap participants are and watching the order flow oftentimes gets you right into the market where you need it. And if you're not seeing that action, you know, there's no law that says you have to transact there. You can just back off and wait until you do see the proper order flow that you'd like to see. In this case, over the last week, wow, we've seen significant moves in these markets based off of our core patterns, and they've led to some incredible moves. And our traders in the trading room just continue to pound it. It's incredible. So that's a testament to you all absorbing the information and then, of course, contributing in the room and us knocking it out together. So fantastic job, everyone. So it says here, notice that your T1 was the plus 10 highs. Do you typically take profit at the T1 right away or wait for weakness before taking T half off? That's a great question because I did not address that. I will go, my goal is to get T1 right away with a plus 10, no questions asked. Just give me a T1 right away. Because my goal is to get to T1 before the first major pullback occurs. Because there's always a pullback. And if you don't get to T1 before that pullback, then funny things start to happen in your brain. You were thinking clearly before you put money on the line. Now you don't start to think as clearly as price is going against you. You didn't reach your T1 and you're like, uh-oh. And then weird things happen, right? It's just what happens sometimes when we have risk on. So for me, what I usually say in the room is, if this is the entry, get to a T1 before this happens, right? Just get to a T1 before that swing, because this swing will happen, right? The market rarely goes like that after you enter. Sometimes it does, sometimes it doesn't, but for the most part, I'd like to get to a T1, take a plus 10, and just be break even. So now I can have the upper hand. I can look to add back with flexibility if I want to, or I can just scale out a quarter up here, quarter over there, whatever the case is. But when you scale half, you get to break even. And that's the most important to me, is preservation of capital. That's the biggest deal. preservation of capital, and when you make an entry, you want price to go as little against you as possible before it hits that T1. Once it hits T1, I do not care what happens. I don't care. It could go in the opposite way 100 points, and I wouldn't feel bad about it because I got to T1 and I was break even, right? On to the next one. But if you don't get that T1 ahead of time, it can be a little bit more of an emotional challenge. And so that's why I say if I'm looking for an entry, I want to see, okay, am I going to be able to get that T1 target first? You know, all these things come into play before you make that first trade. So that's a good question. Thank you for that. And again, for those of you that want to learn more about the trade management, of course, we have our trade management techniques, our core trade management techniques. We have our advanced trade management technique courses. They're all at the dashboard, and this plays right into it because, again, when you're able to pinpoint these zones, it's all about just putting your limit there, triggering that entry, getting to T1, and then just letting the market play out. But again, you have to wait for those major times in the market. Sometimes the market is just doing this, and that's not fun, right? You know, there's not a whole lot of pace, there's not a whole lot of tempo, there's not a whole lot of structure, there's not a whole lot of conviction. But when the market is setting up nicely, when it does hit a major zone and rejects, then you can have a great approach to looking to execute that trade. Remember the execution process that we talked about before. That execution process, very, very important when you're looking to trigger entries. It's forecasting, visualizing, anticipating what would happen, recognizing that signature, and then executing and managing that trade, right? That execution process is a great process to follow, and this is exactly what helped us in this scenario here. We knew exactly what to do when we saw the rejection, and that's all you need to know. Study your rejection patterns. Study those rejection patterns so that you can know them like the back of your hand. When they happen, you'll know exactly what to do. And we talked about pinpointing precision entry points. There's various points along the chart where you can enter this trade. Knowing those entry points for your setups and then confirming it with order flow gives you a massive, massive advantage when you're trading. It's just significant. So this is a powerful way to confirm your entries, and it's a way that we really didn't have a long time ago, especially when I was trading in the mid-2000s. I mean, this technology came out with Market Delta 10 or 12 years ago, but wasn't popular enough for me to know about it, at least. And it wasn't until probably 6 years ago or so that I came into it. And when traders would ask me, back when I worked with a software company, traders would ask me, how do you confirm your entries, right? So that was a big part of our education, was confirming entries, confirming entries, confirming entries. This is the most powerful way to confirm an entry, and we did not have this back then. And this would have been it, right? It's not the only way, it's just one of the great ways to do it. We also used the trail of intentions indicator today as well, didn't we? And that trail of intentions indicator showed a very, very green band of limit orders right here. And it showed the limit orders for us. And that was a super, super green band. And it happened after we identified that as the zone to defend. And then we saw the huge green band come in, we saw it absorb, and then we know the rest is history. So there are many ways to use order flow to confirm your trades. Footprint is one of them, and then of course you have the visual dome is what I call it. Here's another good question. Is the order flow visible on the daily time frame too in order to identify a swing trade or just intraday? The footprint chart can be configured to go higher time frame. So what I do is basically go with a number of ticks, for example. So right now this is a 10 tick range. It says 9, but it's a 10 tick range. So if you wanted to do something for the ES, perhaps you can do like a 20 tick range or something like that, and it'll pop up something that looks like a daily chart, and then that's where you're able to see it much bigger. So yes, you can use it. I don't know if it's I have seen it be fairly powerful in the past, but I haven't really gone that route lately to really see how effective it's been. But anytime you're using order flow like that, it's pertinent information. Order flow is the information you need to know. This is very powerful in an intraday, but this is what I mentioned before. I'm primarily swing trading a lot more lately instead of scalping. But my goal is to enter a swing trade like a scalper. So I enter my swing trade like a scalper so that I can experience as little adverse excursion as possible. And then once I'm at break even, I can then allow it to play out to my swing targets. Add backs, do all those types of things. But my goal is to enter every trade like a scalper. That's why I spent many years fine-tuning my scalping so that I can pinpoint my entries, because primarily I'd like to just get in with a great pinpoint entry and then let it rally for 2 or 3 days, right? And you get that big move from it. So I'm definitely a swing trader that will use this, and I'm also, I'll trade anything in any time frame that looks great. And this is the biggest part of Masters, is the fact that everything I teach you here can be used in any time frame. So any duration of trader you are, if you trade scalping, day trading, swing trading, position trading, investing, all of these concepts can be used in those various approaches to trading. So that's one thing that I did on purpose when I designed my approach, was to be able to create a universal approach to engaging any time frame, any instrument. And that's exactly what we've done here. So I definitely have used this for higher time frame, but even if you do swing, you can pick your spots on the intraday and trigger that way for a swing. So great question again. All right, well, that concludes confirming entries with the footprint. Again, this is a fantastic course here that really puts you on the right side of the market when you're looking for these foundational concepts of trapped participants, right? Trapped participants after rejection, absorption, those types of things, and then looking for those imbalances. Those imbalances will be the fuel that pushes this thing higher. Order flow is all about reading the orders of the market, reading the transactions that are happening right now, because when you can do that, you'll have a very good idea of who's winning the battle and who's losing the battle. And when you know who's positioned where and where their stops are, and you know who's about to lose, you can then start to hunt those stops, and that's what this is all about. So hopefully you all enjoyed the course. Let me know what you think. Try the techniques out, and more good training is coming your way.